Good evening, everyone. I, CA Ajinkya Randive, along with CA Sailesh Bore, welcome you all to virtual CPE meeting on capital gains from house property, shares and units of mutual fund organized by Direct Tax Committee of ICI. I welcome CA Chandrasekhar Chitare Sir, Central Council Member and Chairman Direct Tax Committee of ICI. CA Dr. Raj Chawla Sir, Central Council Member and Vice Chairman Direct Tax Committee of ICI. Dr. CA Dilip Advai Sir, speaker for today's session. I request Central CCM CA Chandrasekhar Chitare Sir to kindly give the opening remarks.
Rajbhai, you first give the word. Raj Chawla, Vice Chairman.
Thank you, sir. Good evening to all. First of all, I welcome all the participants to give our this today webinar on capital gain from house property, shares and unit of mutual fund. And I am thankful to CA Chandrakant V. Chitle sir, Chairman Direct Tax Committee, for giving me this opportunity to interact all of you. I also welcome our today's speaker, CA Dr. Dilip Satbai sir. He will speak on this today topic. I also welcome CA Shailesh Boreji and CA Ajinkya Randaveji, our coordinator for today's program. So friends, let's have learning of this capital gain, which is the most important subject in our Income Tax Act. So over to Chairman sir.
Chitare sir, you are mute.
Good evening, friends. Honorable Vice Chairman CA Dr. Raj Chawla, Direct Taxation Committee, and my colleague on Central Council. Honorable Speaker and my very good friend CA Dr. Dilip Sadbai, and coordinators for this evening, Ajinkya Randive and Shailesh Bore. Both of them are managing committee members at Pune and Pimpri-Chinchwad branch respectively. Friends, as you know, Direct Tax Committee has organized this particular series of webcasts wherein we will be getting very useful inputs for the purpose of computation of income, because in the month of July particularly there will be thick activity about computation of income, and we are having this particular webinar wherein we will discuss computation under each heads. Today, in case of capital gains, we would have definitely liked to cover the entire arena of capital gains. But as you know, that if we cover entire arena, then it would be like 50 news giving in 1 hour. So it is only one liner. You will be just knowing what is the section, that's all, and not the niceties. Therefore, Dilip suggested that instead of having this entire arena, let us focus on the popular area of capital gains. One is relating to capital gain from house property, because commoners keep on buying and selling property, and there certain impacts emerge. Like for example, if you acquired house property, you have taken deduction under section 80C. Maybe you sell after 2 years, 3 years, you are happy that it is capital gain, you reinvest. But then one has to understand that the deduction claimed under section 80C also at times gets withdrawn if it is sold within period of 5 years. So these are the niceties which should be brought home right before we venture to compute the incomes. And secondly, now particularly post-pandemic, number of transactions and number of persons making those transactions in the arena of shares, debentures, derivatives, and securities has increased. Therefore, with your clients, you will find number of such transactions. Maybe in earlier years, if the client does not inform the chartered accountant that he has done transactions in securities, he could simply pass through without anybody noticing. But Honorable Speaker will also point out, now the government has come out, the Central Board of Direct Taxes, with annual information return, and you have Form 26AS and various other information available on website. So whatever transactions you do into securities, they are captured into this particular annual information statement. And therefore, if you miss reporting of these transactions, then the disastrous consequences follow. Therefore, friends, not only we have to consider whatever information is given by the client, but also we have to compare it with this particular annual information return, and then only we will understand whether the entire information has been given or not. And after reconciling it, maybe we can proceed with computation. And how to do those computation, I think today the expert speaker will point out. And I'm sure that Dilip would be able to dilate this particular subject very thoroughly. He has been a lecturer for decades in law college and other colleges, and is very thorough with his study and knowledge. Therefore, we have specifically invited him, and I'm sure he will do justice to this particular topic. So I also welcome Dilip for this particular webcast, and I welcome all of you who have joined this particular webcast. Thank you. Over to you, Ajinkya.
Shailesh?
Yeah. Thank you. Thank you, Ajinkya. Thank you, Direct Tax Committee, ICA, for giving me this wonderful opportunity to introduce and brief about today's session speaker, CA Dr. Dilip Sadbhai, sir. Sir is a practicing chartered accountant based at Pune, being a chairman, vice chairman, secretary, treasurer of the Pune branch in past, and also co-opted member of various committees of Central Western India Regional Council of the Institute, New Delhi, for past several years. Sir was acted as a faculty member of the Institute of Chartered Accountants of India to deliver lectures on GST on all India basis under FIP, and also appointed as the convener of the Pune GST Study Group, a local think tank for studying the GST law and help the needy taxpayer. WRC has nominated Sir as a member of the subgroup of Indirect Tax Committee of WRC. Sir, also a member of the Internal Audit Standards Board of the Institute, also appointed as a member of the study group for government, accounting and financial planning for local bodies in India, member of the finance committee of Maratha Chamber of Commerce and Industry. Sir has written number of articles on the matters of interest on direct taxes, indirect tax laws, economic, commerce and investment consultancy and labor law. Sir, being a senior partner, holds a mentor of the firm and holds master degree in law, and also passed with flying colors in first in the order of merit in University of Pune. Also holds PhD degree in law. Sir's subject for PhD was freedom of speech and expression and media trial, a case of judicial activism. Also in merit list for intermediate and final examination. Winner of National Merit Scholarship for several years. On prestigious Gamandi Prize for acquiring the knowledge in the field of law. Winner of the special prize from Nehru Memorial Fund, New Delhi for professional excellence. Sir has conferred with a special memento for recognition of professional services at the hands of Shri Sharad Pawar, former Chief Minister of Maharashtra and former Union Agriculture and Agriculture Minister for Government of India. Sir, been considered as a sound investment consultant in Maharashtra, masterminded almost all laws, and also visiting part-time faculty member and head of the Department of Auditing and Taxation Department for over 25 years with BMCC and ILS Law College in Pune. A good computer programmer, and SSI has awarded him Certificate of Excellence. Sir has hold certificate, almost all certificate examinations conducted by institute like international taxation, forex and treasury management, not for profit organization, forensic audits and whatnot, including corporate social responsibility certificate and MSc certificate. Also contributed substantial input material in the published 2 handbooks of ICA, naming practical effective under GST and investor awareness program. Sir is the honorary treasurer of International Leprosy Union and Allied Health Alliance NGO. Also honorable treasurer of CSP, another NGO. Also founder and lifetime chairman of Usha Lele Charitable Trust and PD Lele Pratishthan Pune and Mumbai. Also trustee of Kalavardhani Trust, formed by Dr. Sucheta Bidya Chapekar for development of bank talent in the field of Bharatanatyam classical dance. With this brief introduction, I now request CA Dr. Dilip Sadbhai sir to have your word on the session. Thank you, sir.
Good evening, all of you, the participants. Initially, Chartered Accountant Chandrasekhar Chitale, the charismatic and dynamic chairman of the Direct Tax Committee. Mr. Raja Chawla, sir, known to be very popular and a dynamic personality of the Central Council, especially in Direct Taxes Committee. My colleague, CA Shailesh and CA Ajinkya, who are the coordinators for the today's session, and all other participants. Initially, I must thank Chandrasekhar Chitale for having allowed me to speak on the topic that I have selected, and that was, instead of going on a macro level, I decided to concentrate on micro level so that we can discuss about the capital gain that has been arising out of sale of house property, shares and units of mutual funds are concerned. This topic was specifically chosen because there were a number of queries, those have been received on account of the various changes which have been made, and especially the transactions pertaining to the shares and securities, when the number of shareholders, number of share persons who are contributing for purchasing various shares and securities have gone up from 3 crore to 10 crore. So as a result of which, the common man also started investing in various shares and securities and earned certain amount of money by way of profit. Now, whether this profit is disclosed or not, that the government understood that there are sizable profit which has not been disclosed, as a result of which updated return scheme was introduced. This was only to give a way that those who have faulted, they can correct their returns on the basis of AIS or FIS is concerned. So with the help of that now, so many people, so many clients, so many outsiders, those who are not known to me also, they also joined and inquired about what are the things which are required to be carried out. And as a result of which now, the present day's lecture, which was the main basis on which I thought that I should share some knowledge amongst those who are really needing that particular knowledge, and as a result of which the overall progress of the income tax law, upgradation of the income tax law can take place. So this was the theme that I decided. I talked to our charismatic chairman, DTC, Chandrasekhar Chitale. He said that instead of having a discussion on capital gains, it would be advisable, as what I was saying, that we can have a discussion on house property, shares and units of mutual fund. So accordingly, a lecture was organized by him, and as a result of which now I am here today to deliver that particular lecture. So with this brief background, I will straight away start with the topic in itself, and we will continue our deliberations on the topic in itself. Now, to begin with, I need to have some background about when the capital gain normally arises. And while considering that particular factor in mind, in the initial 7, 8, 10, 15 slides in itself, I have given you a general idea about when normally the capital gain will arise. Now, to begin with now, that income from capital gain is what? What kind of thing that normally we ought to take into account so far as the capital gains are concerned. Now, you could be knowing that any profit or gain which is arising out of transfer of a capital asset. So I invite your attention on this major important point, that capital gain is directly related with the capital asset norm or definition. And that second important point is that the transfer must take place during the previous year. So this is the second aspect that what we need to take into account. And the last one is that whatever sections are being there, those are chargeable under the head Income Tax Act and deemed to be the income of the previous year in which transfer took place. So in short, there are 4 important points which are required to be taken into account. First is any profit or gain that is arising out of, then the second is transfer of capital asset has to be there, and then save otherwise provided in section 54, 54B, which we are going to analyze over a period of time, and the amount so earned by way of profit or gains will be chargeable to income tax under the head capital gains. one more important point that you cannot forget, that it will be chargeable to tax in the previous year in which the transfer took place. So, in short, capital gain arises out of transfer of capital asset. It would occur in the year in which the transfer has taken place is the second important and the last point that you need to understand so far as the definition of capital gains is concerned. Now, whenever rule is there, exceptions are always there. And those exceptions are very important as compared to the definition part is concerned. I have highlighted that whenever there is a transfer of capital asset, then capital or the profit or gain arising in the previous year will be chargeable to capital gains in the year in which the asset has been transferred. So, point is, gain arises according to the definition in the year of transfer. That is what the highlight which is required to be understood. So I have told you that whenever there is an exception, whenever there is a rule, there is an exception. And there are some around 4 exceptions which we need to understand, wherein you will find that it is not the year in which the asset is being transferred will be chargeable to tax, or could be in the same or even subsequent years as well. Now, the first exception which I just would like to bring to your notice would be that any sum that has been received from the insurer. Now, when this sum will be received from the insurer will be the major issue that we will have to underline and discuss. That whenever you are having a insurance policy for destruction or damage to the capital asset, which includes the house property as well, and the loss has occurred either due to flood, cyclone, earthquake, accidental fire, explosion, riot, action by enemy, or action taken in combating an enemy, including the civil disturbance in itself. So these are the causes on which, in case you received any compensation from the insurance company in itself, then it will not be chargeable to capital gain and the tax in the year in which the asset has been transferred or the event has occurred, but it will be chargeable to tax either in the same year if the compensation is received or in any subsequent year of receipt in itself. So say, for example, you have a house with you and you have got an insurance for destruction or damage to the property, and that property was burnt in a fire. The year was 22 January 1, 2022. Now, a claim has been lodged by you. The insurance company has taken their own time. According to the original definition, the asset has been lost in the year 21-22. So whether capital gain or the compensation that what is being received will be chargeable in the year 21-22 or in the year of receipt. So in the year 22-23, nothing has happened, but the compensation has been received after 2 years in 23 and 24. So when this compensation will be chargeable to tax, it will be chargeable to tax only in the year of receipt and not in the case of transfer in itself. So this is the first exception that I'm just making out. And there are various other reasons like the fire which I have told you, which is an accidental fire. It can be flood, it can be cyclone, it can be earthquake, it can be explosion, it can be riot, it can be the action by an enemy, action taken by government for combating an enemy, including civil disturbance. Now, for example, nowadays Shiv Sena and their allies are in tug of war in itself, and as a result of which some civil disturbance occurs, and as a result of which loss is being caused either to the property or to the house in itself. In that case, even if the house has been lost in the current year, the year in which the compensation will be received, it will be chargeable to tax in the same year in which the compensation will be received. So capital gain does not arise in this case in the year in which the transfer has taken place, but it will be received in the year of receipt is concerned. Then the second is very important point, which is under section 45(2) of the Income Tax Act in itself, and it talks about the conversion or its treatment as stock in trade. Now, what do you mean by the term conversion and its treatment? There are two important things which you need to assess. First is conversion, which means that it was a fixed asset and now you have made it as as a capital asset or current asset. And treatment is nothing mere but you are considering a particular asset as fixed asset in the balance sheet, but simply you are bringing that particular asset from fixed asset to the current asset. The first one is called as conversion, whereas the latter is being called as a treatment in the balance sheet in itself. So the capital gain will arise in both these cases, whether it is a conversion or whether it is a treatment, is the important point that I just wish to bring to your notice in itself. So in case of conversion, really whatever property is there, it is required to be considered as a stock in trade. So the conversion, the nomenclature undergoes a change in itself, and as a result of which fixed asset becomes a current assets. But in case of a treatment, you don't do anything. Only thing is that the item is being brought from the upper side to the lower side, from fixed assets to the current assets in itself. And that treatment also will amount to arising the capital gains in the transactions in itself. So point to be noted here would be that whenever whenever there are profits and gains arising from transfer by way of a conversion of a capital asset, it could be any capital asset which is considered as fixed asset, now considered as current asset. Even the shares also will be covered in this. Even the units also will be covered in this. Even the houses and the other properties also will be, which are capital asset now, will be converted into stock in trade is being concerned. And second point which I mentioned, or its treatment as stock in trade of a business carried on shall be chargeable to income tax in the previous year in which such stock in trade is sold out. So that is the major issue where I am inviting your attention on. So I have told you in the definition of capital asset that it is chargeable to capital gain in the year of transfer. But here you are transferring in the current year, but it will be chargeable to capital gain tax and to the capital gain in the year in which such stock in trade is sold out. So if you are having shares or if you are having certain house properties as fixed asset, and now you have converted those into the stock in trade in itself, in the same year, it will not be chargeable to tax, but it will be chargeable to tax the year in which the assets will be sold out in itself. So that is the second exception which I just wanted to bring to your notice. Then the fair market value of the asset on the date of such conversion will play a very important role, which will be considered as the full value of the consideration received. So as a result of which, FMV will play a very important role while determining the quantum of capital gain is concerned. So firstly, I told you that it is the amount of compensation received from insurance company. And now the second point, which I have brought to your notice, is about the conversion of or treatment of certain fixed asset as stock in trade or capital asset as stock in trade. Then the third exception which we need to understand is about compulsory acquisition. Now, whenever there is a capital gain that arises out of transfer of a capital asset, being a transfer by way of a compulsory acquisition under any law, or a transfer for consideration which is determined or approved by the central government or Reserve Bank of India, then the compensation or the consideration for such transfer or enhanced or further enhanced transfer compensation by any court, tribunal, other authority, the capital gain shall be dealt with in the following manner. So in short, what I'm bringing to your notice is nothing mere but it's a compulsory acquisition. Normally, the sale takes place when both are voluntarily purchasing and buying and selling. But here, one person is dictating the term, which is the central or state government. When the central government says this is the land that is being required for road widening, this is required for dam purposes, this is required for any other purposes, and as a result of which we are acquiring this particular property in itself. So when the land is being acquired or any other thing compulsorily being acquired, then in that case there is a transfer. And whenever there is a transfer, the question will come that according to the capital asset definition, the year in which the asset has been transferred, the same year will be the year in which capital gain will be chargeable. However, this is the third exception to that particular rule. And this exception says that whenever you receive such compensation or enhanced compensation or further enhanced compensation, it will be chargeable to tax in the year of its receipt in itself in the following manner. Now, issue number one, that enhance, you claim that the property was initially being acquired for a sum of rupees 1 crore. You are not satisfied with the compensation in itself. You have gone to the courts or you have gone to the direct parties in itself and said that compensation is not adequate. But the court said, okay, all right, you are giving a compensation of 1 crore. We will allow a compensation of 1.5 crore. But you know that the decisions of the court normally take longer time, and whenever these longer time the decisions are being taken, decisions are normally being taken in years thereafter. So property was acquired in the year 2019. The first decision came by the court was in the year 2022 after 3 years of span. So the year of receipt will be the year in which compensation will be deemed to be made taxable in itself, and not in the year in which asset has been transferred in itself. So capital asset is transferred in the year 2019, but compensation has been received in the year 2022. But you don't agree with that, and as a result of which you have gone again further in appeals in itself. So compensation was agreed for 1.5 crore instead of 1 crore, 1.5 crore, and you now further have gone to the courts in itself again in appeal. And the appellate court has again allowed, okay, 1.5, we will allow you 2.5 crore rupees in itself. So this is further an enhanced compensation, and that will be chargeable in the year of receipt again. So note this point well. This can go on for n number of times, the moment at which you will be pursuing your query or your dispute in itself. So initially, the first year in which compensation is received will be the year in which whatever compensation is received will be chargeable to tax. In case you have gone and for appeal, and in the appeal in itself some enhanced compensation is being given, the enhanced compensation will be eligible for taxation in itself in the year of receipt in itself. If further compensation is being received thereafter, after 10 years of time, that compensation also will be chargeable to tax in the year of receipt in itself. So as a matter of practicality, I just can bring it to your notice that compensation, if it has been received in this particular case on 3 occasions, and on all the 3 occasions, the taxation will be levied on that. And first will be initial amount, then the enhanced amount will be considered as receipt, and the third one will be the amount that is being considered in that particular matter. Now the issue number 2 was, now when the interest, when the compensation is being delayed, in that particular case, you are eligible for claiming the interest portion in itself. There can be 2 factors for this interest in itself. This interest can be merged with the original compensation, and that entire amount can be considered as compensation. Or the second case can be the amount of interest is being paid for delayed payment. So in both these cases, in the previous times, we were considering this particular compensation which was taxable on accrual basis or from year to year basis, as a result of which the compensation was chargeable to tax on different methodologies in itself. But now you perhaps, I would like to invite your attention on the new section that has been introduced in the Income Tax Act in itself, and as a result of which now the concern, which is ultimately getting enhanced compensation in itself, the receipt will be chargeable under the new subsection 5629 IX9, and accordingly the entire amount that has been received will be chargeable to tax. Note one important point, that under section 57 of the Income Tax Act, 50% deduction for that compensation will be permissible under the new section 57 is being concerned. So note this point well. In the current year only, the compensation is now being considered, whatever case law those I have given, those case laws now practically have become redundant, because section 5629 is very clear on the point in itself, which says that the interest portion now will be chargeable to tax under this particular section, and the deduction will be available under section 57 of the Income Tax Act. So that is the interest portion that what we need to understand and need to take into account so far as the technicalities are concerned. Then the fourth exception, which is the last exception that I just wanted to bring to your notice in itself, and appears to be very, very, very important section in itself, exception as well. It is the transfer of capital asset, being land or building or both, under a specified agreement. Now, the first three parts which I just brought to your notice was, the first one was compensation that is being received from insurance company. Then the second important point that what I brought to your notice is conversion or treatment to the capital asset. And the third one just we finished off, and that is pertaining to the compensation that has been received. And the fourth one now just I'm bringing it to your notice is the transfer of capital asset, being land and building. This applies only to the land and building or both under a specified agreement. Now, what is this specified agreement? This specified agreement is nothing mere but a joint development agreement in itself. Now, let us go to the details. Now, this particular point will be applicable only to the individuals and Hindu undivided families and individual in itself. Now, capital gain arises to an SSE being an individual or HUF from the transfer of capital asset, being land and building or both, under a specified agreement. The capital gain shall be chargeable to income tax as income of the previous year in which certificate of completion for the whole or part of the project is issued. Now, what does this mean? Now, let us take a concrete illustration and try to find out what does this mean. Presume that I have got a land worth a few crores, and the total area of the land is say 10 crore. Now, I have given this particular land to the builder in itself under a joint agreement, and that joint agreement specifies that they will be providing me 50% of the land and 50% of the flats in itself, 50% they will be selling. Note one important point, that this particular agreement, which is I'm talking about joint development agreement, is required to be registered with the competent authorities in itself. That is the area where I just wanted to deliberate some more points on this in itself, because there is one law, that is section 53A of the Transfer of Property Act, wherein part performance was being considered, if it is coupled with possession, was considered as a valid agreement. It was not required to be registered in those particular days in itself. Now, club these 2 points together in itself and let us try to understand what do you really mean by the term transfer of capital asset, being land or building or both, under a specified agreement. I have told you I have got a land, I just cannot develop. I have asked my builder to get it developed with a specific agreement that the 50% of the assets will be sold out, 50% will be given to the builder in itself or retained by me, as the case may be. Now, here, what is the major requirement that is required to be considered is that the agreement in question is required to be registered. If it is not registered, then in that case, many other complications can follow. I have just told you about section 53A of the Transfer of Property Act, wherein it has been categorically stated that whenever there is a part performance, initially it was being dealt with that if it is coupled with possession, and even if the agreement is not registered, still it was being allowed in the previous times, and capital gain used to be worked out. But now, note one very, very, very important point, which is introduced in the current year's budget in itself, and which stipulates that in case under a part performance agreement, possession has been given and the agreement has not been registered, then that transaction will be considered as a Benami transaction under the Benami Transactions Act. This is a very severe clause that has been inserted in the Benami Transaction Act, and as a result of which I just wanted to alert our colleagues in itself and the friends in itself that do not involve or do not get involved in these particular matters, because once you do that only with the help of simple agreement coupled with possession but not getting it registered, in that particular case the situation will be very grave and you are likely to be summoned by the Benami Transactions Unit of the Income Tax Department, which is administered by the Income Tax Department, and you are likely to have many difficulties in itself. Not only the property will be confiscated, seized, but also you will have to pay additionally 25% more by way of a fine in itself. So the loss will be to the extent of 125% in itself. And as a result of which, besides that, there is a provision for rigorous imprisonment, which may vary up to 7 years of time. So keep this particular point in mind, that you can convert your capital asset and being a land and building under a specified agreement, which is the joint development agreement, which we normally call, but don't follow the old techniques, old methodologies, where under part performance section 53 of the Transfer of Property Act, the property is being transferred with possession without getting the agreement registered. So if that is being done as of today, you are inviting problem not only for you, but also for your family, because you are the bread and butter earner for the family in itself. And if the karta goes behind bars in itself, which is the likely case since it has been introduced, you will have to face a lot of consequences in itself. So keep this particular point in mind in itself, so far as the matter is concerned. Now, coming back to the main topic, that this transfer of capital asset, which I have done it, I have converted that property from capital asset to the joint development agreement in itself, and the builder has given me the possession. Now the question comes for consideration, that when this particular property will be chargeable to tax, and the answer to this particular question is not in the year of transfer of land or building in itself to the builder, but in the year in which certificate of completion of the building is being given by the competent authorities, either in part or in full. Even if it has been given a part completion certificate, then in that case, the property will be chargeable to capital gain tax in the year in which the completion certificate has been granted. So keep these particular points in mind, which are very, very relevant and very, very important. The first one I told you about, the sum that has been received from insurance company is an exception. Conversion of capital asset into stock in trade. Then the third one was compulsory acquisition. And the fourth one that just I mentioned about, the transfer of capital asset, being land or building or both, under a specified agreement. So keep this particular point in mind, number 4, which is very, very important. You will be attracting yourself towards Benami Transactions Act in itself, which is very, very, very grievous law, and a very small amendment, but a very having a deep rooted impact on not only the person, but the entire family in itself. So keep this particular point in mind, and as a result of which, year of completion will be the year in which the property will be taxable to the tax in itself. So 2 points I have covered. The first point that I brought to your notice was that when, according to the definition of the Income Tax Act, normally the transfer takes place. Then I have given you the 4 exceptions to the rule, where even though the section says that the year in which it is being transferred, it could, but normally it would not, that the year in which it is being transferred, the compensation will be chargeable to tax, but it will be chargeable in the year of receipt, is the conclusion that I just wanted to bring to your notice. Amount received from insurance company, conversion of asset into stock in trade. Third one was compulsory acquisition, and the last one was that property being converted. So that these are the 4 points which I just wanted to bring to your notice in itself. Now, the next part is very important again, that we are being talking about that capital gain is chargeable only when there is a transfer of capital asset. Now, what do you mean by the term transfer? Transfer means transfer of ownership rights. Now, whenever transfer of ownership rights are there, then in that case, capital gains normally would occur. Now, what is the definition of this particular capital asset will be the major issue that we will have to look into. And that major issue just I am finding out with the help of the slides now. 2 slides are there which will cover up and the complicated matters about this particular definition, which we will see at a later stage. Now, this capital asset is an inclusive definition. It doesn't talk about it is defined as so and so and so and so. It says that the following items are included in the definition of the term capital asset. It is not an exclusive definition. It technically being called as an inclusive definition. So should you come across of any of the following points which I have just been pointing about, then those points will be included in the definition of the term capital asset. Now, the first is any kind of property held by the SSE, whether or not connected with the business. Now, here I invite your attention on what kind of property. It can be movable property, it can be immovable property, it can be tangible property, it can be intangible property, it can be corporeal property, it can be incorporeal property. By whatever name that you may call, it will be included in the clause A by whatever name that is being concerned, and whether these assets are connected with your business activity or professional activity or not, that doesn't matter. If it is connected, very good. If it is not connected, doesn't matter much. So the first part is any kind of movable or immovable property is included in the definition of capital asset. Then the second important point, that any securities held by the foreign institutional investors which has invested in such securities in accordance with the regulation made under SEBI Act 1992. Now here I invite your attention on this point. Now you will agree with me that shares and securities are movable properties, and these are normally to be required to be dealt with, which are connected with either business activity or otherwise. But note this point, that in case any securities are held by FII, then it always would be capital asset in itself. It will never become business asset. It will never become a current asset in the technical sense, because of the privilege that has been conferred by the SEBI Act 1992 on these foreign institutional investors are concerned. So keep this particular point in mind. This is the second item that is being included in the definition of the term capital asset. Now, coming to the third point, just I wanted to bring to your notice, but before that, I would like to cover certain assets which are excluded from the definition of the term capital asset. Now, you are aware that many businesses are being run by various entities in itself, and they hold stock in trade. Now, the entire item of stock in trade, it could be a builder, then house property will be his stock. If he's selling television set, television will be his stock. If one is selling, is a car dealer, then the cars will be his stock in trade. So whatever is the stock in trade, that will be considered as an asset which is not included in the definition of the term capital asset. As a result of which, if you sell stock, capital gain will never occur. It will be only business income that will occur over there. So stock in trade, consumable stores, and raw materials. These are the three categories which are included, which are never considered as capital asset, but they are to be considered as the business asset on which only capital gain will not arise, only business income will occur. So that is the first exception to the general rule of capital asset, which is not included in the definition of the term capital asset. Now, the second one is comparatively more important, and that talks about the personal effects. Now, what do you mean by the term personal effects? Personal effects are either could be movable one, that is normally been the case in itself, and these are the personal effects which are intimately used by the persons in itself. So personal effect, that is movable property, including wearing apparel and furniture. For example, now I am having a Sony TV in my house, 65 inches, worth rupees 6.75 lakhs. So in that particular case, whether that is a personal effect or not, answer is definitely yes. Then there could be a lavish furniture. That furniture also will be, because it is intimately been used by me in itself. And that is the reason why this furniture also will be considered as a personal effect in itself. There are many other categories that you can think about it. And the intimacy, which is very important in this particular matter, that is required to be seen. So the house is in this particular case, which is required to be covered. For example, now painting in itself, paintings in itself. Now, paintings initially was not being included in the definition of the term capital asset in the olden times, but now it is being considered in itself. That's the major change that what we will have to look into. So initially it was there, now it is not there, is the precise point that I just wanted to bring to your notice. Now coming to the important category so far as the jewelry part is being concerned. Now in case of jewelry, the jewelry is not included in the definition of the term capital asset. Now what do you mean by the term jewelry? The jewelry is nothing mere but a, various kinds of ornaments made of either silver, gold, platinum, or any other precious or semi-precious stones, etc., etc., which are normally and intimately being used by the family members in itself. So now the question comes that whether these type of ornaments which are being held, can they be called as a capital asset? Answer is certainly negative. So this is specifically been removed from this particular definition in itself. Now, I would like to invite your attention on certain matters, which normally can be either considered as personal effect or not. That will be the major issue we will have to look into. Now, you are having certain gold coins with you in your house, or bullion that normally is being called as. Whether that will be considered as personal effect or jewelry, as the case may be, answer is certainly negative in itself. Then second aspect that you'll have to ask into would be that you are having some deity. You have got Lord Ganesh, which is made of gold in itself, or maybe of platinum in itself. Gold coins are there; those are also there with you. Certain gold biscuits are there; those are also having with you in itself. And as a result of which, whether this would amount to a jewelry or not, and which will be falling in the definition of the term capital asset or not. Now note this point, this is an exclusion and will never fall in the definition of the term capital asset. It is excluded from the definition in itself. So the major point that you will have to look into here would be, it is neither the gold coin nor the bullion in itself, or gold biscuits or ornaments made of gold, silver, platinum, etc., etc., will be included in the definition of the term capital asset. It will be certainly excluded from the definition of the term capital asset. Now I invite your attention on certain important aspects of silver. Now the silver matter is being there, and you are having some silver in your house in itself. So the stock of silver can be considered as personal effect? Answer is no in itself. Now the question will come, there are certain persons, including my house also, we are using some silver utensils for drinking glass of milk or water in itself. 24/7 they are on dining table. Now the question will come, whether this silver utensil, which I am using it for my consumption purposes in itself, whether these will fall in the definition of personal effect or not, or whether this will be excluded again from the definition of the term capital asset being jewelry. Normally, for a common man, it will be a jewelry, but for me, it certainly will not be a jewelry in itself because of the decision that has been given by the courts in itself. If I am having intimately closed with the jewelry in itself, so far as the silver is being concerned, which are say 10 or 12 plates are there, some glasses are there, some other utensils are there, whereby virtue of which we are using that silver in itself. To a limited extent, it can be included in the definition of the term personal effect. But note one point, that having only utensils does not qualify me to claim that as personal effects, but it will have to be considered as personal effect to a limited extent, to a reasonable extent. Now tomorrow I say, I am having 500 silver plates, I am having 1,000 silver glasses in itself, then I am having some 200 idols in itself, deities in itself. Can these be considered as my personal effects? Answer is certainly negative in itself. So point to be considered here would be that whether the reasonableness is there or not, whether materiality is there or not, whether the reasonableness is to the nature of the family or not. Now, while discussing this particular court, this particular decision by the court in itself, the issue has not been discussed by the court, but I am just bringing it to your notice that for me, I'm having a family of 3%. Dr. Jaswant is my daughter. My wife is there, Rupa, and we three are there. So for three of us, 12 glasses and some 10, 12 plates will be a reasonable one. That is what is being called as. But take a case now. I am going in the history in itself. Present day, a Dhritarashtra is born, and Gandhari is also there, having 100 children with them in itself. Each one is having a house in itself, and each one is being given 12 plates. So in all, 12 into 100, it becomes 1200 in itself. So can that 1200 plates and glasses to the extent of 2400 will be considered as a reasonable jewelry or not, or reasonable personal effects or not? To me, it certainly will be, because it is the reasonableness that ultimately counts. It depends on the family in itself. So quantum is not the material thing which is required to be taken into account, but it is ultimately the effect of it, and the reasonableness of that is required to be taken into account. So as a result of which now, the decision has been given by the court in itself that so far as the silver utensils are concerned, you will be allowed to have the major issue so far as the things are concerned. Now, I just would like to invite your attention on one more point, that one of our clients had given me a gold plate worth around 3 lakhs rupees some 10-15 years back. And he was expecting me to dine in that particular plate in itself, which was made of gold, exclusively gold, nearly 1 kg. Now the question here that we need to understand, that silver utensils are being considered as reasonable one. Can this particular gold plate, where I am now expected to eat rice and chapatis in itself, whether this will be considered as a jewelry, or it will fall in the definition of the term personal effects are concerned? And answer to this particular question will be certainly negative, because the court which has given this particular decision, this particular issue was also raised there, but they have categorically stated it is only the silver utensils to a reasonable extent will not fall in the definition of the term jewelry, but will be incorporated in the definition of the term personal effects. So as a result of which now, the point which you need to understand here is very, very simple. And as a result of which, the major aspect that you will have to cover here would be that these gold plates, gold glasses, or similar other spoons in itself made of gold. My father used to have gold buttons for his shirt in itself. This would not fall in the definition of the term capital asset, but it will be included in the definition of the term exclusion of the capital asset, will be falling in the definition of the term jewelry in itself. So any person having 400 plates of silver, 400 glasses ultimately of silver or gold as the case may be, then 5,000 spoons of silver and gold in itself, this won't be considered as the personal effects, but this will have to be called as jewelry and will be chargeable to tax. One more question that perhaps might be raised by the department: have you specified this particular items of gold as your personal effect in the wealth tax return prior to the abolition of this Wealth Tax Act is concerned? So that also will be a peculiar feature that you will have to look into so far as the technicalities are being concerned. So this is the major issue now that I just wanted to bring to your notice so far as the technicalities are being concerned. Now, so far as the archaeological collections are concerned, those are being excluded. Drawings are also excluded. Paintings are also excluded. Sculptures are also being excluded. And any work of art is also not forming part of the term capital asset is concerned. So I will only talk about paintings in itself, because it is very difficult to value the paintings in itself, because you may not be knowing the real value of the painting. A painting worth rupees 10 can be purchased at rupees 10,000, or even a painting worth rupees 10 lakh can be bought at rupees 10,000. So this is the situation which is being there, and that is the reason why the paintings initially, which was exempt, which was included in the definition of personal effect, now has been included in the definition in itself. Now, the second part which we need to make it out so far as the precious, semi-precious stones are being concerned and the utensils are concerned, and the other items which are showing in the wearing apparel are being concerned. Now, I invite your attention on the old paithanis and shalus in itself in the olden times. They were weaved with gold in itself, and whether that particular weaving of gold to make that paitani and the shalu in itself, in our layman's language in itself, whether would cover under the definition of the term capital asset by way of saying personal effect. Nowadays, that is not possible because the color is being chosen by the manufacturers in itself. Nowadays, gold is not being there. So as a result of which, it will be excluded from the definition of the term capital asset is concerned. Now, coming to the next part, so far as the agricultural land is concerned, the agricultural land in India not being a land situated in. Now, there are the exceptions to this particular rule. Within the jurisdiction of the municipality, notified area committee, town area committee, cantonment board, and which has a population of not less than 10,000. So this is the first thing that is being excluded so far as the matter is concerned. Then within the range of following distance, those have been specified. That if a land, I'm talking about the aerial distance now, that the land is not being more than 2 kilometers away, and the population of the area is more than 10,000, but not less than, but not exceeding 1 lakh. This is the second one. Third one is within a kilometer of 6 kilometer, radius of 6 kilometer, population is more than 1 lakh, but less than 10 lakhs. And the third one is within 8 kilometers, but the population is more than 10 lakhs. So this is the area which I'm talking about, urban area, because this is not pertaining to the rural area. Rural area is excluded from the definition of the term capital asset. But these are the assets which are being considered as urban asset. But beyond these particular limits, these urban lands also will not be included in the definition of the term capital asset. So just I can say you have got a square, and that square beyond that 2 kilometers, 6 kilometers, 8 kilometers you have to see. And any land beyond 2 kilometers, 6 kilometers, 8 kilometers from the jurisdiction where the area of the operation completes in itself, that land will be excluded from the definition of the term capital asset. Then the gold monetization scheme is there, that is gold bonds are there, which are not included in the definition of the term exclusions category in itself. So these gold bonds, I will not specify, old bonds are there, we will not discuss about that in itself. So these are the points which are required to be kept in mind so far as the capital gains topic is being concerned. Now, for example, now, which asset is to be considered as capital asset and which asset is to be considered as business asset? I have bought a bus for transportation of my family member. So whether this will be a capital asset or whether this will be a business asset, it definitely will fall in the definition of the term capital asset. But should there be a case that I have bought a particular bus for carrying and applying a bus for passengers in itself, then in that particular case, it would amount to a business in itself and it will be business income so far as the technicalities are concerned. Then I invite your attention on the section 1037 of the Income Tax Act in itself, which is pertaining to the urban agriculture land, which now we are talking about. Now, under section 1037 of the Income Tax Act in itself, this is applicable only to the individuals and HUF only, because it is not applicable to other SSEs in itself. And these two persons or either of the two persons are using this particular agriculture land for at least a period of 2 years for agricultural purposes. Now, what is this agricultural purposes? Agricultural purposes is nothing mere but you are using or cultivating land for agriculture purposes. So all those operations which are required to be carried out to get a particular crop in action in itself, which is that plowing of the land, harrowing of the land, sowing of the seeds, watering of the plants in itself or seeds in itself, then nurturing that particular plant, using fertilizers, manures, etc. if required, cutting the crop and taking it to the market. If all these processes are being followed, the land will be deemed to have been used for agricultural purposes. And this type of agricultural purposes need to be carried out for a period of 2 years prior to the date of compulsory acquisition in itself. Now, under section 1037, such acquisition, if it pertains to the urban agriculture land, I am highlighting the point urban agriculture land, then it will be exempt under income tax law in itself. Now I have to invite your attention on one more law, and that is being law which is being known as the right to fair compensation and transparency in land acquisition, rehabilitation and resettlement act of 2013. Now here the major issue which you need to understand here would be that in order to mitigate the hardship faced by the farmers whose agricultural land situated in specified urban limit has been compulsorily acquired, clause 37 of section 210 exempts the capital gain arising to an individual or HUF from transfer of agricultural land, and that is again a compulsory acquisition. Now I invite your attention on section 96 of the right to fair compensation and transparency in land acquisition, rehabilitation and resettlement act of 2013. It has been categorically stated in section 96 of the said act. A very long preamble is there and very long name that has been given, which is being technically called as REFLA law in itself. And that particular law says that in case the compensation has been given for an acquisition of land, then in that particular case, section 96 of the that particular law stipulates that it will be exempt under income tax law as well. So this is a very, you may call it as an overlapping amendment that has been made. So if you find that the land in question has been acquired under this specific law in itself, then the entire compensation will be exempt under the income tax law in itself. So that is the reason why agricultural land or the other property which is being talked about is very, very relevant and very, very important so far as the things are concerned. Now, one more ticklish issue is being there in this particular case, that after the passing of this law, that is all right, compensation has been received, will be free of tax. But one additional point is being there, section 26, 28 and 34, which states that even if this law has been introduced in the year 2013, but the compensation was allotted prior to 2013, but the compensation has been received under the old law, which has been repealed now under the present category in itself. Even the old compensation, which was been considered as taxable under the old law, now that will be exempt under section 96 of the right to fair compensation and transparency in land acquisition, rehabilitation, resettlement act of 2013 is concerned. So this law is very, very important so far as compulsory acquisition is being concerned. And that is the reason why we need to concentrate on this so far as the topic is being concerned. Now, note this point particular well, that this particular law applies exclusively to the urban land. It also applies to the rural land, but the importance lies in the acquisition of compulsory acquisition of the urban land is being concerned. Now let us proceed further. The first point is that I have told you capital asset. What is capital asset? Then exceptions 4 that I have brought to your notice. Then I have given you the clues about what do you mean by the term capital asset, and now the kinds and the classification of capital asset. Now there are two types of capital asset which we'll have to look into. The first one is short-term capital asset, and the second is a long-term capital asset. If you see the original definition, you will find that if you are holding the asset, the ownership rights thereof for a period less than or equal to 36 months, less than or equal to 36 months, it is a short-term capital asset. And if you are owning the asset for a period greater than 36 months of time, it is called as a long-term capital asset. So keep this particular point in mind. This is a unique and uniform definition. 36 months is the time for short term as well as the long term so far as the duration is concerned. 36 months complete, it will come in the short term. More than 36 months, it will come in the long term. Now a proviso has been made to this particular 36 months time is being concerned, and it has been pointed out that in case of shares and securities, equity or preference share as the case may be we are talking about, or other listed securities.
मैसेज आ रहे हैं पीछे से मैसेज आ रहे हैं आपके
So somebody is muted, need to mute out the audio and video as well. gentle request for muting the audio in itself. So the major point which we need to understand here is there is a proviso that has been made that in case of shares and securities, the short-termness and long-termness will depend on the owning rights of that particular shares and securities up to and inclusive of 12 months are concerned. So if the ownership is of the shares is equal to or less than 12 months of time, it is short-term, and if it is more than 12 months, it will become long-term capital asset. This is equity-oriented funds that I'm talking about. And one more now that has been added here, and that is pertaining to the land or building or both. In that particular case, now the ownership rights have to be for a duration of equal to or less than 24 months. It will be a short-term capital asset. And if it is more than 24 months, then it will be considered as a long-term capital asset. So this is what the major issue that you will have to look into so far as the matter is being concerned. In case of unlisted companies in itself, the duration of the short-term and long-termness will depend on the ownership rights up to and inclusive of 12 months or 24 months. It will be short-term, and more than 24 months, it will be a long-term. Now, keep this particular point in mind that these are always being considered as the short-term asset, that is units of UTI, units linked to the equity-oriented funds or zero coupon bonds. These are excluded from the definition in itself. Now, long-term asset, I have already told you, so we will not deal with this longer. And with this brief background now, I will just move on now to section 54, because this was the background that I just wanted to cover up before discussing any matter pertaining to the capital gains topic was being concerned. Now, section 54 of the Income Tax Act, which specifically talks about the selling of a residential house, buildings or land appurtenant thereto, then capital gain will arise in case you have sold out the property in the year in which it has been purchased. Then the duration will be less than 36 months of time or 24 months of time, depending on the duration in itself. So now I just would like to bring to your notice that if a residential house is there and that residential house has been sold out, then in that case, the capital gains arising from that particular sale of house property will be exempt from Income Tax Act if the entire capital gain, entire long-term capital gain is invested in buying another new house property within a period of -1 year, +2 years, or constructed within 3 years. Now let us take some concrete illustration with the help of which we can understand this particular provision and situation well. I am owning a house worth rupees 50 lakhs. I would like to shift my place from 3 bedroom to 4 or 5 or 6 bedrooms in itself. So I have sold out my property, which was bought for rupees 50 lakhs for 2 crore rupees in itself. So how much is the capital gain by indexation, etc.? We will find out that later. But 1 crore 50 lakhs is the technical capital gain which has been arised. I am using this particular property since last 15 years. So as a result of which it will be a long-term capital asset. A long-term capital gain will arise when I own the property for a period beyond 24 months are being concerned, which is the present law. Now, this 1.5 crore is required to be invested within -1 year, +2 years, or +3 years of construction. Now, presume that on 1st of January 2022, I have sold out the property. So what are the options? Those are available to me. Either -1 year. -1 year means what? I have to buy a property first, and then I have to sell out the property in hand in itself. For example, I'm having surplus funds with me in itself, and I have purchased a property sometime in the last year in the month of June in itself, 6 months prior to the date of sale in itself. Now, I have bought the property first, that was worth rupees 2 crores. And now I am selling out on 1st of January, the next property which I am owning at present, not the one that I bought, but the place where I used to stay. And that property worth rupees 50 lakhs is sold out for rupees 2 crore. Now the capital gain earned is 1.5 crores. Now, am I supposed to pay tax on 1.5 crore is the issue. And the answer to this particular question will be no, since I have purchased the property within 1 - year of time, from 1st January to 31st December, this will be the period, or 2nd of January to 1st of January, this will be the period within which I am supposed to buy the property, which I have done it in the month of January or June, as the case may be, and as a result of which, -1 year is the point, as a result of which the amount will be exempt, no need for me to pay taxes in itself. The second case, that I have not purchased the property out of my own funds, but now I would like to buy. So in that particular case, what I will have to do, I will have to purchase the new property within 2 years of time is being concerned. In the meantime, the day before which my income tax return becomes due or falls due, I will have to deposit that entire money in the capital gains account in itself. So once the capital gains account is being opened, either by way of a term deposit or by way of a saving deposit, the amount can be kept over there for a period of 2 years of time. On the last day of the 2 year, I can remove that particular amount and can deposit that particular amount to the builder. Entire capital gain will be tax free in itself, provided I buy the property equal to that of the amount of capital gain is concerned. And the third part is that if I am constructing, then the duration will be 3 years. I have to keep that particular amount in capital gain for a period of 3 years of time is concerned. Now, this is the case of entire capital gain stands invested, but that may not be the case in every situation. Either 90% gain is invested, or 50% gain is invested, or only 20% gain is invested, or no gain is invested. These four possibilities could be there. So in that particular case, what will be the situation, whether capital gain will be chargeable to tax or not, is the precise issue that what we'll have to look into. Now, note this point well, that capital gain, if it is invested, which is of a long-term nature, only to the extent that has been invested will be tax-free. So if the capital gain is 1.5 crore and I have invested only 30 lakhs, then 1.2 crore will be chargeable to tax. If I have invested 50 lakhs, then 1.5 minus 50, 1 crore will be chargeable to tax. If I have invested 1 crore, then 1.5 minus 1, 50 lakhs will be chargeable to tax. But if I have not invested anything, then entire 1.5 crore will be chargeable to tax, is the precise point that where your attention is being invited upon. So note this point well, that the property is required to be considered and it is required to be purchased within -1 year, +2 years, and 3 years of construction is concerned. Whatever is being required is the entire capital gain needs to be invested. If part of the capital gain is being invested, then the remaining in capital gain, which is not invested, will be chargeable to tax in the year in which the failure normally occurs. This was the point. Now, one more point is there in case of this particular category as well. Now, the new house that I'm going to buy, I cannot dispose of this particular property for a minimum period of 3 years of time. This period was 5 years initially, but nowadays it is 3 years of time. So if I have bought the new property on 1st of January 2022, then I cannot dispose of this property prior to the 1st January 2025 is concerned. I can dispose of later, but not earlier in itself. Is there any via media by virtue of which we can plan out certain things? And answer to this particular question is yes. And what is that? Just I'm highlighting to you in itself. Now 2 years have passed. And now after 2 years of time, you have sold out that property which ought not to have been sold by you prior to the 3 years of span is concerned. Now the question will come, whatever capital gain is being there, that was being made exempt, that will be reduced from the cost of acquisition, and accordingly you will have to pay the tax. So we will take some concrete case. The property that has been bought by me is worth 2 crore. Capital original asset was worth rupees 50 lakh. Capital gain long term 1.5 crore. I have bought the property, but I have sold that particular property in the year 2023 January, after 2 years of time. Now the question will come, how much capital gain will be chargeable to tax. Now, again, the major issue will be whatever capital gain is being there, that capital gain will be chargeable to tax in the year in which the transfer took place. Now, here is a question that we need to understand, that there is a possibility that you can buy another house within 24 months of time, because 24 months time has been given to you in itself, and the person can invest that particular property in buying another house is being concerned. So initially what I brought to your notice was that 36 months was the time. Now I am giving you an illustration of 24 months of time, and now the property which was bought by me, which ought not to have been sold by me in 36 months of time, I have sold out that particular property within after 24 months of time. Now, whatever capital gain that has occurred, now that capital gain normally would be chargeable to tax in itself. But I am suggesting you one more point, that instead of paying tax on that in itself, you can buy another house in itself in case you need a smaller house than the bigger house that what you sold out. Another option that is available to you, that you can invest that particular amount of capital gains in section 54EC up to 50 lakhs of rupees in one financial year, so that to that particular portion, the amount will be tax free. So you can do both, that either you can invest 50 lakhs in buying a 1 crore in buying a house property, and 50 lakhs of worth rupees in investing in 54EC. So don't worry about that. Even if the property has been disposed of within a period of 36 months of time, nothing is going to happen, nothing is going to collapse on you. The amount that will have to be looked into is very simple matter, and that you will have to look into, that there are some provisions which are being there, which is because the period of duration that has been shortened in case of land or building or both in itself, this tax planning has been made possible in itself. So in case again that period of 1 year, 2 year, 3 year also would be available to you, because this is again a capital gain. You can invest minus 1 year, plus 2 year, plus 3 years, as the case may be. So accordingly, you need to concentrate on these particular factors which are comparatively more important, and this is the way that you have to look into the matter. Then amendments recently has been made, recently means few years back has been made, and it has been pointed out that you can buy only one house was the situation. But now it has been made very clear that if the capital gain that has occurred or arise is up to 2 crore rupees in itself, then in that particular case, you can buy 2 houses in itself now. But if the capital gain exceeds 2 crore rupees in itself, then you can buy only 1 crore rupees in itself, one house in itself. So up to 2 crore, if it is the capital gain, then you can buy 2 houses in itself. And if the capital gain exceeds 2 crore, you can buy 1 house in India in itself. Mark the word in India, the reference of which we will find out in the later part of the topic in itself. So that is the reason why we need to cover up this particular issue in itself. So this minus 1 year plus 2 year, I have already brought to your notice. 3 years of construction, that already I have brought to your notice. Then 2 residential houses, just I have brought to your notice in itself. And that is the reason why the property is not required to be sold out, is the precise issue which I just mentioned to you. In case of capital gains bond also, that I have already mentioned in itself. The consequences also I have brought to your notice in itself. Now, I have to invite your attention on certain further slides that will be very important so far as the matter is being concerned, and that I would like to discuss that first before I go into the more details are concerned. Now, interesting points are there which are required to be understood by you in itself. That normally we suggest that whenever the things are being moving, house has been sold out, you would like to buy, but you don't want to buy in technical sense. So you have kept that money deposited into the capital gain account in itself. Now, this may be possible in case of a family if the property belongs to the senior citizen, a very old senior citizen. In that particular case, this CBDT Circular 743 dated 6th May 1996 will be of some help. Because the point which I am insisting and bringing it to your notice is comparatively relevant. Now it has been pointed out that in case the amount has been kept for a period of 3 years in capital gain bond, because you have to construct a house in itself, and before completion of 3 years, just within 2 days of keeping that amount in capital gain account in itself, the person has died, then what will happen? Is it the legal heir that is supposed to pay the amount taxes in itself, or will be exempt under the income tax law? Now it has been made by the CBDT wide circular 743 dated 6/5/1996 that in case the capital gain amount has been deposited and the person who is the owner of that particular account dies, then in that particular case, the entire amount will be exempt under income tax law. After 3 years of time, that was chargeable to tax at 20%. But now it is totally exempt under income tax law, is the precise point that I just wanted to bring to your notice in itself. So keep this particular point in mind so far as the technicalities are concerned, and with the help of that, you need to consider this particular issue so far as the matter is being concerned. Now, going back to the point in itself, the major issue that what we need to cover up, that is it necessary to buy only one house, or you can buy multiple houses? 2 houses are already permitted. Can you buy 3? Can you buy 4? Can you buy 10? Is the issue which I have to just bring to your notice. And that is the reason why some 4 or 5 instances I have given, 5 instances have been given. That one, this is the old point. So before the introduction of the topic in itself, 2 houses were being prescribed. 2 flats have been purchased in the same building, in one building, on the same floor. So flat A, flat B, and those are being joined by demolishing the wall in between the 2 flats in itself. Can those 2 flats be considered as one? Is the issue. Second, there are 2 flats on 2 different floors, and now it has been made in such a way that holes have been made in such a way that ultimately now it looks to be, by putting a ladder, it becomes like a duplex in itself. So 2 flats were purchased, those have been made as duplex. Now the third issue is that 3 flats have been purchased on 3 different floors in the same building, but there is only one kitchen, there is only one ration card, but the children are using for study and sleeping purposes in itself. Fourth case, 4 flats have been purchased, 1 is given on rent, 3 have been occupied by all members of the family, but it is in the same building, whether this will be one house or one flat. And the last one, 3 small flats have been purchased in 2 different buildings out of capital gain of rupees 2 crore. Now here your attention is being invited on certain matters in itself, and some decided case law is there. The first case which I am going to deal with is the CIT versus Geeta Dugal's case. It's a Delhi High Court decision, and it is decided in IT Appeal 1237 in the year 2011. The date of judgment is 21st February 2013. Now, what had happened in this case was that under a development agreement, the builder constructed 3 floors, the land belonging to the lady. The builder constructed 3 floors, out of which 1 floor was retained by the builder and 2 floors were given to the landlady in itself. Now, the question that was required to be clarified before the judge was, from the above decision, what is the decision now that I'm just bringing it to your notice, that even if 2 floors have been given to the Geeta Dugal in itself, that was considered as one house in itself. Only for 2-3 points they considered that one house is the word that has been used in the section in itself, but the court asked the concerned competent authority of income tax department, why have you taxed the second flat in itself as additional flat which is beyond one house in itself? The argument that was being laid down by the Geeta Dugal's lawyer was very simple, that it has nowhere been specified that in order to claim a particular benefit, the manner in which the flat is required to be constructed. Law has not specified. He can stay in one small room, he can buy another bigger room on the 2nd floor, 3rd floor, 4th floor, or he can reside in species in every places in itself. So manner in which house is to be constructed is nowhere specified in the section in itself, and as a result of which the question will come for consideration whether the amount is required to be taken into account or not. And answer to this particular question was very, very simple. The court held in this particular case that ultimately the intention of the legislature is required to be seen. The words used are one house or units, as a result of which this can be considered as a unit in itself, and as a result of which one house does not necessarily mean, in a chauvinistic approach, the amount of money that has been invested of capital gain in only one flat. So even two flats will be considered as one house, provided it is in the same building. So the words which are required to be marked are same building in itself. And if it is in the same building in itself, the major thing that you will have to look into would be that one building will be considered as the major issue for considering whether you are buying one house or not in itself. So that is the precise point where your attention is being invited upon. Now, the other two cases which are of similar nature, so these are confirming the decision that has been given in the earlier case, and it is the case of CIT versus KG Rukmini Amma, which is decided in the year 2008, order dated 27th of August 2010. Another case is Ananda Basappa case in itself. It's a Karnataka High Court case in itself, binding on all the matters in itself. So as a result of which, the chauvinistic approach taken by the department that the house means one residential unit is not correct. This is the ultimate ratio that I'm just bringing it to your notice. And as a result of which, only one house does not necessarily mean a house means a singular house, but if you see the other words in itself, where they have used the word buildings, lands, etc., in plural number in itself, and under section 13(2) of the General Clauses Act in itself, it specifies that when the word when the word a is there, it includes plural. When the singular word is there, it includes plural. When the plural word is there, it includes singular in itself. And that is how you have to look at the point so far as the technicalities are concerned. So in the light of that now, just I'm bringing it to your notice that if the flats are located in the same building in itself, the answer would be that it would be exempt under section 54. It is not necessary that you need to buy one flat, which is being specified in the section in itself. So these case laws ultimately give more attention on this particular point so far as the technicalities are being concerned. So it has been pointed out that Income Tax Department, while discussing these two cases in itself, they pointed out that how you can stay in 3 flats or 4 flats or 6 flats, as the case may be in a recent case. It has been pointed out by the lawyers of the defendants in itself that ultimately Income Tax Department has to see the investment in long-term capital asset in the same building. Whether they stay there or not is none of the concern of the Income Tax Department. So as a result of which, when the big persons, the big rich persons in itself, like chairman and managing director of Mukesh Ambani, he can stay in 29 floors of Atlanta, which is the tallest building occupied by Ambani in itself, in Bombay in itself. When he can stay in 29 floors or in 29 floors in itself or units in itself, why the SSE cannot stay in 3 flats was the issue that was ultimately being talked about. Ultimately, the things came to the light, and now the present situation is very simple, and that ultimately highlights the issue that whether you are selling the house property or not, you are buying the house property or not, how many houses are required to be purchased, that has already been settled out, and as a result of which now the major issue that needs to be looked into is not one house, but if there are 2 different houses in itself, 2 different buildings are there, you can buy 2 houses in itself, 2 flats in itself, 10 flats in 2 buildings in itself, that is being permitted, is the major issue that I just wanted to bring to your notice. Now, there are 2 important situations which I am getting so many letters from various residents and non-residents situated inside, outside India. And for their clarification now, these two case laws, I am just bringing it to your notice. An SSE who is a resident in India thought that it is not that it is getting good returns or good employment is not there and would like to settle outside India. Maybe he could be going either to the United Kingdom or United States of America, Canada. And as a result of which, he thinks that he would stay there for good in itself. Permanently, he will stay over there. And now has decided to dispose of his spacious house in Mumbai. And now would like to invest those sale proceeds in period of 2 months of time in buying a house in United Kingdom. So situation is very simple. A person who is at present resident of India has got house property which is chargeable to income from house property prior to the date of sale in itself. It's a long-term capital asset and he has disposed it of for say 25 crore rupees in itself. Now that 25 crore rupees, now he would like to utilize that particular amount minus the amount of cost of acquisition, say 5 crore. So 20 crore is the capital gain. And that 20 crore he wishes to invest in buying another house property in United Kingdom in itself. Now the question will come, he has purchased that particular property within a period of 2 months of time. He has not waited for capital gains account and other things in itself, and he has bought the property now within 2 months of time. And now the issue here would be that whether the capital gain will be exempt under income tax law or not. And answer to this particular question is very, very simple, that it has been categorically stated in section 54 or even 54F that the house property to be purchased must be located or situated in India. So since this gentleman is buying a property outside the taxable territories of India, the entire amount of capital gain will be chargeable to tax. Indexation is available, but capital gain that has been arising from this particular transaction will be chargeable to tax. So far decisions have been given, but as you know that it is very difficult to find out the mind of the judge in itself because conflicting decisions are being there. But now since the introduction of the word India, in 2008, I remember, a decision was being given that ultimately the property invested in UAE was being considered as exempt. That was wrong decision, but that may happen over a period of time. By the High Court was given, Supreme Court ultimately overruled that. But sometimes it happens. I can give you one small story by virtue of which these errors can be identified. Two gentlemen lawyers were being there. They were quarreling with each other, saying that this particular capital gain is exempt under income tax law. The other one was saying, no, it should be taxable inside India because capital gain has occurred in India. Source theory, capital gain is taxable inside India. The other person was saying, since now I will be staying, I am a resident now or non-resident, on residential basis, it should be exempt. Quarrel started and the first lawyer said to the other one, if you are saying like that, then you are the greatest donkey on the earth. Getting irritated by these words, the other lawyer say, you don't understand the law. You are the greatest donkey on the earth. So this process continued. You are the greatest donkey. You are the greatest donkey. One was saying to the other was saying to the first. The judge was looking to the left, was looking to the right. Again looking to the right and listening. You are the greatest donkey. You are the greatest donkey. And all of a sudden, the judge said, wait, order. Don't quarrel with each other. I'm here. So as a result of which, you are the greatest donkey, you are the greatest donkey. Order, I'm here. So it indicates that there is a slip of tongue by the judge in itself, and with the result of that, you can make it out that any decision could be possible. It depends on how the interpretation of law is being carried out. So as a result of which, even if the precedent was being there, since it is an overruled decision in itself, ultimately the capital gain in the first case will be chargeable to tax. The second case is different. It was a non-resident SSE residing in United Kingdom or United States. He wants to come back to India. He is frustrated over there and coming back to India. He is selling out his entire spacious property in US and now coming back to India within again 2 months of time, buying another house property in India in itself. Now, in this particular case, whether the capital gain again will be exempt under income tax law or not. That is the issue which we need to identify. Now here again, there are certain issues which are required to be looked into. That capital gain is exempt under income tax law under section 54, that provided it is a long-term capital asset, and the second is income from that particular house property is chargeable to tax under section 22 of the Income Tax Act. Now the assessee in this particular question, being a non-resident Indian, having a house in United States, that house is not chargeable to tax inside India in itself under section 22 of the Income Tax Act. So even though it is a long-term capital gain, still it will not be considered as a asset which is chargeable to tax in itself, and as a result of which will not be exempt under Indian income tax law. So any person going from India to foreign country, or any person coming from foreign country to India, and they are selling out their long-term assets, getting invested either inside India or outside India, will be chargeable to tax for capital gain, is the conclusion that I just wanted to bring to your notice. Now coming back to my topic in itself, section 54, that where I left unfinished in itself. So I will continue with that in itself. And before that, I just would like to invite your attention on section 54B of the Income Tax Act, which talks about agriculture land. So agriculture land I will deal with at a later point of time. Before that, I will concentrate my deliberations on section 54 of the Income Tax Act. Now there is a difference in between section 54 issue and section 54F issue. Now who are the eligible assessee like 54? These are individuals and HUFs. What are the conditions which are required to be qualified? Section 54 talks about transfer of residential house. Here it is other than residential house. This is the difference in between 54 and 54F. 54 and 54A both applies to the individuals and HUFs only. It doesn't apply to any other assessee. Second important point, in case of 54, it has to be a residential asset. But in case of the 54A, it has to be other than the residential asset in itself. So that is the main difference. Third point, both cases have to be long-term capital asset. House has to be for a period of 36 months, as well as the other part 24 months, and the other also has to be for 24 months. Then the transfer of plot or land is also eligible for exemption, which means that if you have sold out land and invested the net sale proceeds into the buying a house in itself, then in that particular case, the amount will be tax-free, provided entire net proceeds have been invested in itself. Then the assessee should purchase one residential house situated in India within a period of 1 year before, 2 years after the date of transfer, or construct one residential house in India within a period of 3 years. So all those aspects which I just brought to your notice are being considered over there in itself. Minus 1 year, plus 2 years, plus 3 years is the category which is there, which is again there in case of the 54 and 54F is being concerned. Now the assessee should not own more than one residential house at the time of date of transfer. That is another condition which is required to be specified. And one more thing that is required to be considered, the assessee should not purchase any other residential house within a period of 2 years, or construct any other residential house within a period of 3 years from the date of transfer of original asset. So keep this particular point in mind, that no other house is being permitted under 54F, but that is permitted under section 54 of the Income Tax Act. Now let us take one concrete illustration, and with the help of that, we can find out that how much amount of capital gain will be exempt. Now again, the same illustration will continue. 50 lakhs was the original cost. 2 crore is the sale proceeds of a plot that was being bought by me long back. Now, how much is the capital gain? Capital gain is there to the extent of 1.5 crore. Now, what is required to be invested in case of 54F is concerned? not the capital gain which is there in case of 54, but it is the net sale consideration. What is the net sale consideration here? The net sale consideration is 2 crores. So if at all you have to claim benefit under section 54F of the Income Tax Act in itself, then you have to invest an entire 2 crore rupees to cover up the entire exemption of 1.5 crore rupees in itself. If you invest 2 crore rupees in buying a house property in itself, then only 1.5 crore worth of capital gain will be exempt. Now take a case that you have not invested entire net sale consideration, but you have invested only 50% of that. So instead of investing 2 crore, you have invested only 1 crore rupees in itself. How much capital gain will be exempt? It is exactly the 50% of the capital gain which will be exempt under the income tax law. So capital gain is 1.5 crore. Only you have invested 50% of the sale proceeds. So 75 lakhs will be the amount of capital gain that will be chargeable to tax in itself. So if it is 25%, the same situation. If it is 75%, the same situation. You have to consider the investment is only up to 75%, then 75% of the capital gain will be exempt. If you are invested only 50% of the net sale consideration, only 50% will be exempt from capital gain. If you are invested only 25% of the capital gain, only 25% of the capital gain will be exempt. If you are invested nothing, entire capital gain will be chargeable to tax. Is the consideration, the formula which has been specified here in itself. So this is the situation which you need to make it out. Again, the same situation is being there so far as the sale of the house property is concerned. And only thing is that you cannot buy house property, but you can invest in 54 EC is the precise issue that what you need to make it out. The possibility is there that you can invest certain matters in these particular matters. Now here I have just drafted the difference in between these two. That investment you have to make in bonds in itself. So far as the situation is being concerned, the table ultimately speaks about if you are investing in 54 EC, then within period of 6 months of time, you have to invest that amount and accordingly get exemption from the capital gains in itself. So this is what the capital gains AS account scheme is being there. 54, 54B, 54D, 54F are being covered in this particular category. Now time limit is being specified that you have to deposit this particular sum before the due date of filing of return in itself. So if you have sold out the property in the earlier year, then you have to invest those capital gain. If you are a salaried employee, before 31st of July. If the date is extended, then till that extended date, you can invest. If you are an audit assessee, accordingly 30th of September or 31st of October, depending on the date and due date that has been specified, will be the date on which you are supposed to deposit the matter in itself. So this is what the general two important aspects that I just wanted to cover. One small topic about 54B also I have to cover in a small way. I will finish it off within 5 minutes of time. Now 54B talks about agriculture land, which is being used for agricultural purposes. And if you sell out that particular agriculture land and again bought another agriculture land within a period of the one that what I just specified, again that capital gain will be exempt from Income Tax Act in itself. So again, the same situation is being there. And that is how we have to look at the point so far as the technicalities are being concerned. Now, I have spent too much time on the house property in itself because I was aware that I will not be in a position to cover up all the three topics in itself. But at a flash point, I have just made it out here that whether I can give justice to the topic of shares in itself. And that is the reason why I have skipped out certain items from house property is concerned. Now, so far as the income from capital gains on shares are concerned, first you have to determine first that whether shares those are being sold out are your capital asset or are in stock in trade. If they are capital asset, capital gain will occur. If it is stock in trade, the business income will occur is the major issue that what you will have to look into. Now the capital asset are again divided into two parts. One is the short-term capital asset, which is chargeable to tax under the section 111A, whereas long-term capital asset shares which are being dealt with are covered under section 112A if you are routing out the sale of shares to stock exchanges or equity oriented funds are being concerned. Now the period duration that has been specified is a period of 12 months of time. 12 months included in the definition of the term short-term capital asset. So say for example, if you have purchased a share on 1st of January, 31st of December will be the last day before which the 12 months will be completed. And on 1st of January, 12 months will be said to be complete. So if you sell the share on 1st of January onwards, it will be a long-term capital asset. And accordingly, it will have to be treated the manner in which it is required to be looked into. So that is the precise issue that what we will have to look into. Now, if it is a case of a derivatives in itself, you might be knowing that if it is a case of futures and options in itself, it definitely would be called as a business income. Keep it in mind always that whenever we are talking and thinking about the terms of derivatives in itself, futures or options in itself, it will be a business income, always a business income, so far as the technicalities are concerned. The major question that you will have to look into would be that in such cases, whether the transactions about derivatives is concerned, whether and how the audit case is required to be identified. Now here you have to look into the matter in a very simple and logistic way. You have to consider in case of derivative all losses which have occurred during the period of year, all incomes those have occurred during the course of year in itself, all income and profit and losses are required to be merged together in itself, and if that amount exceeds rupees 1 crore in itself, then it will be a case of audit matter so far as compulsory audit is concerned. I invite your attention on the word that I am using, losses or profits. I am not using the word receipts. Receipts means the sale proceeds. I am talking about the losses and profits in itself. So if you have sold out shares worth rupees 15 lakh for 14 lakhs 90,000 rupees, there is a gain of loss of whatever is there. The shares worth rupees 15 lakhs are sold for 14 lakhs 90,000. There will be a loss of 10 lakhs of rupees. In another transaction, you have sold out shares worth rupees 15 lakhs for 16 lakhs of rupees. There is a gain of rupees 1 lakh. So these receipts and other things are not required to be considered. A summary of all losses, summary of all gains is required to be taken into account. They are to be merged together in itself, and that turnover will become the turnover for ascertaining the crossing of limit of rupees 1 crore. Now there is there was an amendment to this particular section. If that 95% of the transactions or 95% of the transactions which are being carried out by the SSE are through banking channels in itself, then in that case, the limit of 1 crore was raised to 5 crore, which has been raised now to 10 crore rupees from this year. So 10 crore rupees is the limit, provided you transact entire transaction through banking channels in itself. You are having a liberty to incur expenditure in cash to the extent of maximum limit of 5%. You should keep that limit less than 5%. You can avail the limit of 10 crore rupees as of today in itself. So keep this particular point in mind so far as derivatives are concerned. Now coming back to the topic of shares and securities in itself, that capital, when the capital gain will arise, only on the basis of transfer, that what I made it out very clear to you in these particular cases. And note one point, that one gentleman who is either individual in itself, he cannot have both capital, these shares in the capacity of stock in trade as well as capital asset. Either he has to choose that all his shares are falling in the capital assets category or in stock in trade category. Recently, in one of the judgments, a passing remark, it's an arbiter dicta. It's not a ratio in the technical sense, but it is an arbiter dicta, which is a passing remark while giving a judgment on certain matters. The judge has observed that you cannot have both hybrid method in the same situation, but you can have two different portfolios with two different categories in itself, wherein in one case you can have a capital asset category, and in the second one you can have the stock in trade category in itself. Those should not be mixed with each other, though at the year end the profit or loss in both cases can be merged. So this was a passing remark by the judge in itself, which is an obiter dicta in the technical legal language, and that is the reason why we need to consider this particular aspect in the technical sense is concerned. So keep this particular point in mind so far as the general situation is being concerned. Now, generally, you will ask me a question that whether a professional like chartered accountant, lawyer, can they have these futures and options in the matter in itself? Can they deal with this? And the answer to this particular question will be certainly negative, because a chartered accountant is not expected, lawyer is not expected to perform and carry on an additional activity of business, and that being the reason will not be permitted in the general matters. So keep this particular point in mind so far as the technicalities are being concerned. Time is running out. I have to close before 5 minutes to 9 in itself. So 4 minutes are being left out because Raj sir is already there on the screen in itself. Good evening, sir. I am not keeping you waiting for a longer duration of time rather than only 2, 3, 4 minutes of time, because the topic is so big that I was just wanted to give justice to all topics in itself, but it seemed that the topic is too vast in itself, and even I was not in a position to complete and give justice to the entire topic that ultimately was planned out. So I feel now that I require at least a period of 5 hours to cover up the entire session of capital gain on exclusively on house property, shares, and units of mutual funds are being concerned. So keep this particular point in mind. I would not like to give more emphasis on the certain transfer which are not being considered as transfer. Initially, in brief manner, I would like to cover a few of them. Now, in case you are having a Hindu undivided family and a partition, total partition I'm talking about, has been carried out. And because of the shares owned by HUF now, the shares have been distributed to the co-partners. Now the question will come, the shares have changed their ownership from HUF to co-partners in itself. Will this be considered as a transfer in itself? And the answer to this particular question is that if it is a total partition, it will not fall in the category of transfer in itself. One more question that perhaps you might raise, that what will be the duration of the ownership of those particular shares? Whether the duration of the shares held by the HUF will be considered at the time of sale? And the answer is yes, it will be covered up. The day on which HUF purchased, right to the date when the co-partner will be selling out, will be the duration for which the shares will be held. Indexation, if it is unlisted one, will be available. Second important point that we need to understand is about any property that has been given by way of a gift will also be excluded in the definition in itself. Now keep this particular point in mind, that if any property that has been given by way of a gift will be tax-free so far as the transfer is concerned, because it would not amount to transfer in the technical sense. So gift of shares again will fall into two categories. If it is given to the relative, different story. If it is given to the non-relative, again a major question that you will have to look into, whether it really will be chargeable tax or not in lieu of section 56(2)(10) is being concerned. So in this particular category, FMV will be the major issue that you will have to look into, and tax will be chargeable to the non-relative category is concerned, but it will be exempt under the category of relative is concerned. But a hypothetical case, just I would like to bring to your notice, that I have sold out, I'm using the word sell, shares worth rupees 10 lakh for an inadequate consideration of rupees 4 lakhs. So 6 lakh rupees has not been received by me, and the amount has been sold out to my sister. Now the sister falls in the definition of the term relative. Now the question will come, am I supposed to pay tax on 10 lakhs, or whether there will be any additional amount that will have to be paid by the donee in itself? Now the word sale has been used, the word sold has been used, and if it has been sold out for inadequate consideration, whether it is to relative or others, I will have to pay tax to the extent of 6 lakhs of rupees on FM on the basis of FMV. 10 lakhs is there, 4 lakhs is the consideration, and accordingly amount will be chargeable to tax if it is for non-relative person. If it is being sold out to the sister in itself, she has paid me only 4 lakhs, 6 lakhs is the inadequate consideration. it will be chargeable to tax under 56 210 in itself, and tax will have to be paid on that. So FMV will be considered for non-relative, and accordingly the amount will have to be paid. So sizable, around 60 slides are being still left out, but since Raj sir is there, and I do not want to waste his time for this, so I will conclude by simply putting a small story. A similar hall was there, some lecture was being going on, offline mode was being there, and it was not in India, but it was in United States of America. All whitish faces were being there, and the lecturer came and was expected to deliver a lecture for 2 hours of time. The lecturer came, started delivering a lecture, completed lectures for 2 hours of time, but did not stop. He continued for another 10 minutes of time. The participants were a little bit irritated, saying that already 2 hours are over, this lecturer is continuing his lectures in itself. So the whitish faces started becoming reddish. It became pinkish initially. Another 10 minutes passed. The pinkish faces started becoming reddish, indicating that the anger was on a boiling point. They did not want the lecturer to speak more. But since he was being invited, participants had no other alternative. Then another 10 minutes passed, total half an hour was being lost, but the lecturer did not stop, he continued. Then all of a sudden, a person sitting on the last bench just got up, reddish face, looking toward the dais in itself, took out a gun, started marching toward the dais. The lecturer saw him and said to the concerned participant, "Don't come forward. I'm going to conclude in another minute's time." But the surprise was on the part of the lecturer. The participant said, no, you continue your lectures. Then the lecturer said, "But still you are marching toward the dais. Are you going to kill me when I'm delivering a lecture so that in future I should never deliver a lecture?" Then the participant said, "Nay, don't worry. I'm not going to kill you, but I am going to kill those who invited you over here in itself. So I don't want Mr. Raj sir or Shekhar Chitale sir in the matter ultimately, who will be the victim of that in itself. And that being the reason, a general feature, Raj Savla sir is being there. He will understand that ultimately the gain is required to be considered and the other parts are being there. So this simple story I have just highlighted to you in itself. With this brief background, I just would like to bring to your notice that the issue is being there, and that on that particular issue, I just would like to conclude on this particular matter. So this is what the major aspect that I just wanted to share with all of you in itself. And the remaining slides just I'm sharing with the institute in itself. So I'm thankful to Raj sir for remaining present at the conclusion of the lecture in itself. And I also thank our charismatic chairman, Shekhar Chitale, who ultimately is always a guiding force for all of us. Raj sir is a very popular figure that I have also understood from various sources in itself. His authority on the tax law is also excellent in itself. And that being the reason, I sincerely thank Raj sir as well as Shekhar sir, including my two friends in Pune, that is Ajinkya and Shailesh in itself, for giving me an opportunity to come over here and share some of my thoughts. I'm not saying that I shared my entire thoughts, some of my thoughts on this particular issue. So over to you, Raj sir.
A very big thanks to you, sir. A very good evening to all the members of CA fraternity and my professional brothers and sisters. I, on behalf of the Institute of Chartered Accountants of India, wholeheartedly thanks CA CV Chitle sir, Chairman of our Directors Committee, CA Dr. Dilip Satbhai sir, eminent speaker on our today's webcast, CA Shailesh Boreji and CA Ajikya Ranteveji, who are the coordinator for this VCM, and all our viewers and listeners. I would like to express my gratitude to all esteemed speaker, CA Dilip Satbhai, for his excellent deliberation in today's VCM on capital gain from house property, shares and unit of mutual fund. organized by the Direct Tax Committee of ICI. It was really a privilege for the members of the profession to listen to a great personality on this topic of contemporary relevance. I take the opportunity to thank you, sir, once again for sparing your valuable time with us. I hope that viewers have gained vast knowledge and rich experience from this webcast. I would like to thank all Direct Tax Committee personnel who organized this webcast in very efficient manner. On this note, I like to conclude this VCM. In case you have any query or feedback, please feel to share it at DTC, Direct Tax Committee at ICI.in. So happy learning. Thank you. Good night to all. Thank you, sir.
Thank you.
Thank you, sir.
Ajinkya, thank you. Shailesh.